And we also know that the labor market's cooling as well. But any significant cut in rates could have a negative effect on all the Fed's work in bringing down their inflation to where it's at today. Now, our high in inflation was 9.1%. Any economy that sees inflation go above 6% has an 85% chance of seeing inflation rear its ugly head again just when you think you've got it under control. Remember, that happened back in the late 70s, early 80s. Now, we also have a fairly influential financial leader by the name of Jamie Dimon. He's the CEO of JP Morgan Chase, and he's been doing the rounds the last few days telling us that we're running a very real chance for stagflation, right? Which is a worse outcome than a recession, he says. I might have to agree with him there. I'm sure my next guest is going to have something to say about this story. So please welcome to the show, Rebecca Walser, Walser Wealth Management down in Tampa. Yeah, stagflation is no good because basically that is a stagnant economy with high inflation. If we start going down this interest rate cut cycle, there's a real chance that something like that could happen. What do you say about it?
Absolutely, Scott. So we are definitely in the precipice of potential stagflation. And all that means is that the Federal Reserve, or our central bank, is going to become accommodative again. They've already become accommodative, even though we don't see it technically. They QT reduced. In other words, their quantitative tightening, the reducing of the balance sheet, the Federal Reserve's balance sheet by almost $100 billion a month. That got reduced substantially, only $25 billion a month. So they're already back into the stimulus mode. And we need that right now, Scott, because the liquidity crisis that, like the Japan reverse carry trade and all those things, are all liquidity-based crises. And the money is drying up in the system because the central banks have been tightening for the last couple of years since 2022. And now I'm talking specifically about the United States, which means that as liquidity is drying up, it's going to be harder and harder. And so the Fed is going to be under so much pressure to go back into accommodative stimulative mode again, Scott, and that, by definition, will create stagflation because we still have high unemployment. We still have global recession coming, or already here. If you look at a lot of the economic indicators, they say no longer are valid, but they are still valid. And so we really probably already are in recession just by the disinversion of the 2 and 10 remaining at this point.
So well said. And so I'm going to make it really simple. You know,
yeah,
I'm an old man. Right. But what I see happening in front of my face with the Fed is that they're breaking the laws of nature. They're trying to manage an outcome, and they're not letting just the market and capital markets take over. And so what happens when you do that, because I really think that they got in our back pockets in the last, 07, 08. What happens now is we're gonna get a day when the Fed is out of our back pockets, and we're gonna get a day when the capital markets do revert back to what they are, used to be. But the pain that we're going to feel then when it really boomerangs back will be much worse had they just let the market take its natural course. And so this is why I don't like it, is because this is all financial engineering to me. They're not letting it just happen. And it's because I know they all want to have, like, both sides of the aisle do it. They want to have a nice, you're not allowed to lose money anymore. The market's not allowed to go down anymore. I mean, every time you see the stock market sell off 1 or 2 or 3%, you've got Congress people saying, hey, we need to get the Fed involved. We need to cut a full percentage point. That's insane. Back when I started in the business, we would just let things run their course. And if they had to, they did. And if they didn't, they didn't. I mean, but now you're not allowed to see the market go lower. And this managed outcome, I just don't like, because it's not free markets.
It's not free markets. There has been, if you just look at the S&P 500 at its inflection points, which is a JP Morgan product that they put out every single month, Scott, you can see a market change in the market, the S&P 500 with inflection points since 2008, 2009. And that is when we really switched gears at the Federal Reserve to modern monetary theory, which is basically what you just said in a nutshell. We are going to print until because we now believe we can print without repercussions until the cows come home, as long as it can service the interest. And you are right. This has been a situation where we have not been allowed to fail since 2008. You can't even count 2022 because 2022 was really them getting tighter on the fact that they had just basically, between fiscal and monetary stimulus, printed 10 trillion in the United States with coronavirus. So the Fed had to get in there and raise rates off of the 25, federal funds rate that we had for 15 years. They had to raise it up because we had so much stimulus so fast. And that's the only reason you saw the Fed go in there and really raise rates to a more normalized rate. But guess what, Scott? The reason that senators are now saying we need a bigger cut, we need a 50 basis point cut, is because we cannot sustain maintaining assets at this level of a Fed funds rate. Once you add a risk premium in in there. It is so much higher than what all these assets were bought at between 2008 to present day. And so they have to get this cut. And that is ridiculous. And you are right. And the pain that it will unwind this. This is the largest economic global unwind we will ever witness in the history of time, because it is the end of debt fiat currency. And that is the problem.
Oh, man, you said it so well. It gives me goosebumps. And it's basically the sugar water that everybody got addicted to in running their business and buying their assets, and the way that the world since 2008, it's just not realistic. I mean, go back and look at an S&P chart, Rebecca, from going back to 1970. And when you get to 07, 08, you can definitely see the fear is gone and the market goes straight up. And that's because the Fed became so accommodative. The sugar water and all the punch bowls were put back out on the tables, and it was have at it, boys. Good times are here again. And you know what? That's not going to last forever. It can't.
Yeah, it's like watching The Wolf of Wall Street, and the only scene you ever watch is the party scene. Like, everyone needs to crash sometimes.
Right. I can't do it better than that. We're ending on that. Thank you very much, Rebecca. Rebecca Walser, Walser Wealth Management in Tampa, Florida. Thanks for being on.